is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 5 a.m. in New York, 10 a.m. in London, 5 p.m. in Hong Kong on this Monday, April the 18th. Our top stories today. Investors call on China to boost stimulus to revive a stalled recovery. Meanwhile, Goldman Sachs says there's a 35% chance of a U.S. recession in the next 2 years. Ukraine's President Zelensky wants a visit from Joe Biden. Zelensky says the U.S. president should take a first-hand look at the devastation caused by the Russian invasion. And Bank of America reports first quarter earnings before the opening bell. Investors are focused on the outlook for loan growth. Welcome to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards is off today. Kailey, what do you see in terms of the markets?
Well, of course, a lot of markets aren't open today, Matt, as it is the day after the Easter holiday. That means pretty much all of Europe is closed and a lot of Asia was closed as well. Two markets, though, that were open for trading, Japan and China. Both of those equity markets moving lower. Japan down 1% and China down about 0.5%. Of course, the big story out of Asia overnight was the economic data from China. You did have GDP growth surprising to the upside, 4.8%, but that doesn't fully reflect the lockdowns that went into place in Shanghai and other areas of the country starting in mid-March. Plus, you had the biggest decline in consumer spending and the highest unemployment rate since all the way back in the depths of the pandemic in early 2020. So that weighing on risk sentiment in China, not weighing too heavily, though, on the Chinese yuan, which is actually fractionally stronger against the U.S. dollars, trading right around 637. And the dollar, though, stronger against the Japanese yen. Once again, the Japanese yen at its weakest since 2002, trading right around 126.61. You have Kuroda out of the BOJ starting to ramp up his warnings on the yen, talking about how rapidly this move has happened. Maybe a bit of a verbal warning there. Now, as for the picture here in the U.S., of course, we will be open for trading today. It does look like it will be a down day for U.S. equities, at least judging by the action in the futures market, with futures down across the board. But it is big tech in particular that is lagging. NASDAQ 100 futures down about 0.6%. Of course, the bond market was open for cash. Trading treasuries were in Japan overnight, but that closed around 3 a.m. Eastern time. So while we were up about 3 basis points in Japan, 286 on the 10-year, that's where we've been for about 2 hours now. Cash trading and treasuries will reopen later on this morning. Then we have some other risk assets moving lower, Matt. You have WTI moving down today about a quarter of a percent or so. 106.68 is where we trade on a barrel of crude. And also risk sentiment, the lack of it really weighing heavily on Bitcoin. It is back below the $39,000 level, down about 3.5% in the last 24 hours or so, Matt. It, of course, is at its lowest in about a month.
Yeah, it will be interesting to see if the Easter market closures or also a spike in COVID cases can slow the market down a little bit today in terms of volume. Let's see what's going on this week. As I said earlier, Bank of America is going to be the last of the big Wall Street banks to report results today. That's before the bell. Tomorrow, Netflix kicks off the big parade of tech earnings, and Tesla's results take center stage on Wednesday. Also on Wednesday, Emmanuel Macron and Marine Le Pen face off in a live televised debate before the second round of the French presidential election. And on Thursday, Fed Chair Jerome Powell, ECB President Christine Lagarde, as well as Indonesia's finance minister, all three take part in a discussion on the global economy hosted by IMF, and you'll be able to see that on your Bloomberg terminal. Now, China reported its biggest decline in consumer spending and worst unemployment rate since the early months of the pandemic. Investors are now adding pressure on policymakers for more stimulus to help reignite the recovery. Bloomberg's Kriti Gupta joins us now to give us the latest. Kriti?
Yeah, well, we were going into Friday talking about a reserve rate requirement ratio cut and a rate cut as well. There's supposed to be stimulation kind of measures, and you didn't get that when it came to the equity market. You actually saw declines on Friday. You also saw everything ending about flat when you come to the Chinese market as well. So that puts the new focus, especially when we talk about declining consumer spending that Kailey was just talking about, and now COVID continuing to spread as well. I believe 3 deaths now reported in Shanghai coming out of the bigger outbreak that officials were were trying to contain. So now they're trying to put the focus on the loan prime lending rate, which is coming on Wednesday. And the idea here is that this is a rate that essentially becomes the de facto benchmark lending rate and actually affects the property sector, which we know the consumer spending sector has kind of dropped. The Chinese consumer isn't as strong, but lucky for the Chinese economy, they don't have to be, right? Because this doesn't have the same impact as, say, the American consumer does, where they do have a little bit more impact as the property sector, and that's where that loan prime rate really matters.
So that's the growth story in China. Kriti, let's talk about the growth story here in the U.S. Goldman Sachs out over the weekend, putting 35% odds on a recession over the next 2 years. What can you tell us?
Well, Jan Hatzius over at Goldman coming out and increasing his recession odds to 35% over the next 2 years. As you said, Kailey, this is really significant because, once again, 35% is by no means a majority. But what he does rely on is essentially historical precedents here. He's talking about historically large declines in the gap between job openings and workers has never been this large. And in tightening cycles, we've had about 14 since World War II. 11 of them have seen recession within 2 years. The difference, though, is are those recessions comparable to the recessions we've seen since the global financial crisis? Of course, they don't take into account the impact of QE and therefore consequentially QT. And remember, Kailey, going back just a couple years ago in 2016 through 2019, that latest tightening cycle, you didn't actually see as aggressive as a market impact as you did in the previous recessions and previous tightening cycles before. So the question here is, which precedent then do you follow? Jan Hatzius really saying that 35% is what he's sticking with.
Yeah, saying that historical patterns suggest the Fed's facing a hard path to a soft landing here. Thank you so much to Bloomberg's Kriti Gupta. Now let's turn to geopolitics. In Ukraine, defenders of Mariupol have been encircled by Russian forces, but have not surrendered the port city. Ukrainian officials have warned of a possible naval landing operation and additional airstrikes. Meanwhile, President Volodymyr Zelensky says he hopes President Biden will visit to survey the devastation from Russia's invasion. Emily Wilkins, Bloomberg government reporter, joins us now from Washington. Emily, what are the odds that President Biden actually makes that trip?
Well, we've heard President Biden say that he would like to go to Ukraine, but we've also heard from the White House that there are security concerns and that they don't at this point expect either Biden or Vice President Harris to be going. We have heard that they do want some sort of senior official from the U.S. to go to Ukraine. Obviously, we saw UK's Prime Minister Boris Johnson go the other week. We've also seen Zelensky go ahead and reach out to French President Emmanuel Macron for asking them to also come and to visit. And I think it's going to obviously be something to see what happens with security, what happens with the next few stages of this conflict as to who is going to be going from the U.S. and whether Biden might be taking any sort of trip in the future.
I wonder about financial support here for Ukraine. It looks like they're looking for more of it from Washington. What are they going to get? What are they likely to get?
Yes, we're going to see Ukrainian finance officials coming to Washington this week. They're going to be speaking with the IMF as well as the World Bank, asking for more financial support, for more humanitarian aid. Right now, Ukraine's running about a $5 billion deficit each month just because of the conflict that's going on right now. We also have heard reports that the World Bank is planning a $1.5 billion package to aid Ukraine in the coming weeks.
All right, Emily, thanks very much. Emily Wilkins there, Bloomberg Government in Washington, covering the story for us. Now, back to Wall Street. Bank of America will report its first quarter earnings today, with analysts and investors focused on the outlook for loan growth. Let's get more with Bloomberg's Wall Street reporter, Sonali Basak. She joins us here in the studio. So, Sonali, the last of the big Wall Street banks reporting today. What are we looking for?
Well, first of all, we know that Bank of America is expected to really benefit from rising net interest income. But Matt, how does that hold up in the face of inflation? And as Jamie Dimon calls it, the storm clouds on the horizon. What does the consumer look like into the second half of the year if they don't respond well to those rising interest rates is of key interest here to investors.
Meanwhile, elsewhere in banking, Sonali, tangentially related to the Twitter saga and Elon Musk, who really wants to buy that company, the banks have chosen sides. Who's on which one?
Yes, you have three of the biggest investment banks tangled up in this saga. You have Morgan Stanley, no surprise there, advising Elon Musk. Elon Musk, the man who runs his family office, is actually a former Morgan Stanley banker. Morgan Stanley has given billions of dollars really to Elon Musk in the form of loans here. And Goldman Sachs is over on the side of Twitter. Goldman Sachs was the lead underwriter in Twitter's IPO. Twitter's former CFO and current CFO came from Goldman Sachs. And Twitter has also added JP Morgan, a bank that's not been afraid to tussle with Elon Musk in the past. We know Goldman Sachs has worked with Elon before, but when it comes to JP Morgan, they've actually been in a lawsuit regarding stock warrants when it comes to Elon Musk and Tesla there. So it will be an interesting drama, as you know, Kailey.
A lot of players involved in this. Thank you so much to Bloomberg's Sonali Bostic. And I would point out Twitter shares are actually higher by about 2% in pre-market trading this morning as the saga continues to play out. As for some stocks also moving in pre-market trading, I want to talk about the other company Elon Musk is involved with, and that is Tesla. Shares are up about 0.5% in pre-market trading. Reports crossing less than an hour ago that it could restart output at its Shanghai factory as early as later today. It, of course, has been closed for several weeks due to the lockdown more broadly in Shanghai. But Tesla about to put into place measures including sleeping bags and mattresses for workers at the factory to actually sleep there, operating on a closed loop system. So Tesla is moving higher. A lot of other stocks moving lower early on today, though, including those tied to cryptocurrencies. I was talking about the losses for Bitcoin around the lowest level in about a month. That is translating through to some of these equities, including Coinbase, the cryptocurrency exchange. It's down about 1.7% before the bell. And also down before the bell, pretty much all of the travel complex. That includes cruise lines like Royal Caribbean. It's down about 1.6%. And the airlines under some pressure as well, Matt. American down about 0.6% in early hours.
All right, interesting to watch, especially as we have this once again rising COVID curve. Coming up, the risk of Turkey's neutrality. We'll discuss how Erdogan's actions could affect the war in Ukraine and how the fear of recession is affecting markets with Matt Maley, Miller Tabak, chief market strategist. Plus, defending Musk's management will look beyond the headlines to assess the billionaire's companies and how he runs them. This is Bloomberg.
The economy is strong. The labor market is basically back to close to where it was before the pandemic, with the unemployment rate around 3.5% and other indicators showing that we have very strong demand for labor. So I do think from a monetary policy point of view, it does make sense for us to move expeditiously towards more normal levels of the federal funds rate and also to move forward on our balance sheet reduction plans.
That was New York Fed President John Williams speaking exclusively with Bloomberg's Michael McKee on Thursday. We often look at things in financial markets through the lens of ETFs and flows, and I'm doing that right now with TLT. That's a long-term Treasury ETF. We've seen really big drawdowns, probably not surprising as the Fed prepares to raise rates substantially over the past few weeks. But the interesting thing is the drawdowns that we've seen recently with TLT, which is a long-term Treasury ETF, surpass even the drawdowns that we saw back in the financial crisis in 2008 and 2009. Let's bring in Noor Al-Ali, Bloomberg Markets Live editor, now to talk about how this interest rate hike cycle, how this rising rate environment is affecting other places in the market. Noor, it's probably the single biggest mover of markets over the past few weeks and months, isn't it?
Yeah, absolutely. And what you're talking about here is the world's biggest and most liquid bond ETF. So it's basically the go-to vehicle for exposure against longer maturity treasuries. But I think the thing to note here, if you're a portfolio manager with a 60-40% portfolio, or like you're looking at a diversified mix of equities and bonds, you're going to want to sell the winners and buy the losers. And in this case, bonds have been performing better relative to equities, and that's what you're seeing here. But, on a wider scale, you've got China and COVID still being a big story there. And obviously, we don't have a lot of data coming up until the May FOMC meeting. So a lot in the mix right now is the market really trying to position itself for the next rate hike news that's coming up from the Fed.
Well, and on that subject, we've gone from curve flattening to now curve steepening as the market tries to assess QT and the implications a bit more. Is this steepening sustainable, Noor?
Well, it really depends on whether or not you think the Fed or, other central banks in developed markets are committing a mistake, or, are they behind the curve? A lot of the market participants think, oh, we're still very much worried about inflation, and we're worried about the Fed overcommitting itself and really being too aggressive with the monetary policy, especially as we get into still the economy's not recovering as well as we would have wanted them. And it really disputes whether or not you think that's happening, and that's where the steepening would come in. Or, for some people, they think, oh, no, I definitely believe the Fed. I'm still gonna, trust them. But that's becoming a lot harder to sustain as we get into, more tightening from the Fed, and we're not getting the economic data that supports a better recovery in the economy.
So that's all on the macro picture side of things, Noor. How much more does that matter right now than micro, even now that we're in the throes of earnings season?
Well, look, I mean, if I would say that when you've got a portfolio where you're looking at, value versus growth stocks, or you're looking at, for instance, a commodity basket. I mean, right now, gold is just about to breach the 2,000. The dollar is really gaining. So, in terms of identifying single name stocks that could definitely help you get better returns on your portfolio, I think that's very helpful. We have seen some disappointing data from banks earlier this week, and, we're getting into some more interesting news coming out of Twitter and Tesla. That's all very entertaining, but ultimately I think the macro picture is going to win here, and portfolio managers are very much aware of that.
I saw at the end of last week, Noor, I saw an interesting chart out of Europe showing that airlines haven't had the recovery that maybe some had expected with the passing of the pandemic, shall we say. Now, having said that, we've just got a new mask mandate in Philadelphia, and we're seeing a spike in COVID infections across the U.S. here. Do you think markets are concerned, a little bit on edge right now about this infection coming back?
Yeah, absolutely. I would be. I mean, I'll give you an anecdotal experience from my end. I was in India a couple of weeks ago, and, Goa, definitely a big tourist destination. Now is the time to go there. Absolutely dead. You do see a lot of the vendors there talking about how, oh my God, 20-30% of flights not really being there. China is still, with the COVID resurgence, really picking up on that pace. These developing economies, very big consuming countries, on the commodities basket, still reeling from COVID. And you're going to see that seep still back into these developed markets, especially in the UK and the US, where they are, pretty hefty travel destinations. So I'm still pretty much worried about COVID, but not to the extent that I would say it's going to impact lockdowns locally, because, a lot of us in the UK, for instance, our vaccinations rates have picked up. We're never going back to lockdown. That's what everyone will tell you. No one wants that here, but definitely still a bit of a problem for developing economies.
I thought we'd never go back to mask mandates, and now we see them in Philadelphia. The question is, does this help Jay Powell at all in terms of holding back continued inflation, or do we see maybe, as Jan Hatzius is talking about, a bigger rebound later on in the cycle due to the reopening?
Yeah, I mean, look, it's pretty tough, right? I mean, I don't want to be a policymaker today, I'll tell you that much. I can definitely say that they've got a lot on their plate here. You do have the case of inflation really running hot. You have unemployment still pretty much low and within contained, and it really tests now things like economic concepts like the Phillips curve, and things like the wage price spiral. And we're not going to get into that here because it's not an economics class. But what I can tell you, though, is we are in a place where, definitely the Fed is at a point where they are raising rates. They are starting to tighten. You look at, for instance, out of China, in the PBOC, they're loosening right now because they have to, and that's quite interesting because you see the divergence there. And the potentially issues here coming on is whether or not these, raising rates will help tame inflation that's been driven largely by supply constraints and issues that are still stemming from China. I mean, the data that we had that just came out of China still does not factor in the latest lockdowns that, that have just, mask the whole entire country. So we are seeing a place where it's very difficult. It's a tightrope, but you do have a lot of economists that still strongly believe that the Fed is on the right track. We're getting there. Yes, perhaps we're a bit slower, but I think it all depends to May 4 when the FOMC comes back in.
Yeah, a lot of economists still putting their faith in the Fed. Noor, thanks so much for joining us. Noor Al-Ali there at Bloomberg MLive. You can check out her blog by typing MLIV Go on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York. Anna Edwards is off today. Now keeping you up to date with news from around the world, here's the first word. Billionaire Roman Abramovich has traveled to Kyiv in a bid to restart peace talks between Russia and Ukraine. Abramovich, of course, has longtime ties to Vladimir Putin, and Bloomberg's learned he met with Ukrainian negotiators. Talks had stalled after evidence emerged of Russian atrocities against civilians. Moscow has denied those reports. China Eastern Airlines has resumed flights using the same type of plane that crashed last month. It's a sign that the airline is working toward putting its entire fleet of Boeing 737-800s back in the air. China Eastern grounded more than 200 of the jets after the crash. The cause of the disaster hasn't been determined. Meanwhile, in China, Shanghai has reported its first deaths in the midst of China's biggest COVID flare-up. Tens of millions of people have been barred from leaving their homes as part of lockdowns. That's led to criticism that China's COVID-0 policy is inflicting too heavy a social and economic toll. And in the UK, Prime Minister Boris Johnson faces another rocky week following newspaper reports about the Partygate scandal. The stories say a Downing Street gathering took on the nature of a coronavirus lockdown-breaking party only after Johnson arrived and started pouring drinks. The Prime Minister's office declined to comment. So that saga, Matt, continues.
Yeah, Partygate continues, although I think there's probably a lot of other things to focus on right now. Coming up, holding out in Mariupol, we'll discuss the latest that's happening on the ground in Ukraine next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Investors are calling on China to boost stimulus to revive a stalled recovery. Consumer spending took a dive there in March, and unemployment rose to the highest level since the early part of the pandemic. That's due in a large part to lockdowns. Meanwhile, here in the U.S., Goldman Sachs sees a 35% chance of a recession over the next 2 years. In Ukraine, President Zelensky wants a visit on the ground from President Joe Biden. Zelensky told CNN the U.S. president should take a first-hand look at the devastation caused by the Russian invasion. The White House has said neither the president nor the vice president will make the trip. And on Wall Street, Bank of America reports first quarter earnings before the opening bell. Investors are focused on the outlook for loan growth. The lending business of B of A and its rivals suffered through historically low interest rates and weak demand, and that could change right now as we see the Fed raising rates. I'm Matt Miller, and along with Kailey Leinz, we're in New York. Anna Edwards is off today in London. England closed for the Easter holiday. Kailey, what do you see in terms of the U.S. markets this morning?
Well, of course, we are not closed, although we are opening up from our holiday on Friday, and it does look like it will be a down day. Futures lower across the board this morning, but as the tech-heavy NASDAQ 100 that is really underperforming, those futures down about 0.7%. You are seeing yields moving higher in the bond market, or at least they did when Treasuries were trading in Japan. That closed around 3 a.m. Eastern time. Cash trading will reopen a little bit later today. Of course, it's not ongoing right now because of that London holiday that Matt mentioned. Right now, the 10-year Treasury yield is at 2.86. You're seeing oil moving a little bit lower, only down about 0.3% on WTI, trading at 106.61 a barrel, but moving a little bit more substantially lower today. Bitcoin back below the $39,000 level at its lowest in about a month due to some of the risk on sentiment that is prevailing today. Now, with that move lower in Bitcoin, you're seeing crypto-related equities moving lower in pre-market trading as well. Riot Blockchain, one of them, it's down about 2.5%, but a plunge in early hours for DD Global. Of course, this is the Chinese ride-hailing company listed here in the U.S. It's holding a meeting on May 23rd for shareholders to vote on its delisting from the U.S. stock exchange. That stock is down about 19.5%. before the bell. Moving higher, though, Twitter, the saga with Elon Musk continues. What does his "love me tender" tweet mean from over the weekend as he pursues an acquisition of that company? We're waiting to find out, but right now Twitter shares are up about 1.25%. And finally, of course, it's also earnings season. Bank of America on deck. And just over an hour from now, around 6:45 a.m. Eastern time, its results are expected. That stock up about 0.6% ahead of that, Matt.
We know what Elon Musk means, right? I mean, it's pretty clear and pretty funny. Also, you got to give him some credit. Let's get to something that's not at all funny. In Ukraine, Mariupol, defenders are holding out against an onslaught of Russian forces. Kiev warning of a potential naval landing operation and additional airstrikes or continued airstrikes. Bobby Ghosh joins us right now, Bloomberg Opinion Editor covering foreign affairs, to talk about what we should expect. Bobby, thanks for your time. First of all, on the request for President Biden to come over, how unlikely is that? Vladimir Zelensky wants to show the U.S. president firsthand the devastation that the Russian attack has caused.
Well, you can bet that Joe Biden wants to go. That's the sort of person he is. But the security of the American president is hard to maintain in the best of circumstances, and in a war zone, that's doubly difficult. I'm sure his security officials around him are advising against, but I wouldn't put it past Joe Biden. I mean, especially since Boris Johnson has already been, there will be a desire to go see for himself. Biden also has an important, it's not just about his personal feelings. He needs America to keep paying attention to Ukraine, and going there himself or sending a very top official there is one way to maintain that level of attention, which is very important because we're now 2 months into this war and people's patience with it is beginning to fade.
Yeah, they want NATO to provide planes. They want a no-fly zone. They'd love it if we just got into the conflict. It's understandable that we won't. On the other hand, can Western Europe stop sending, hundreds of billions of dollars to Moscow to finance all of this?
Well, that's the big thing. Zelensky is beginning to bring that up more and more, and the Ukrainians are describing this as blood money, the money that is being sent to Russia for all that natural gas and some oil that the Europeans need. Now, the Europeans are trying to find other sources. It's not easy to make that switch, but it's been 2 months now, and those efforts need to accelerate. And that's the point I think Zelensky is making. He has the moral high ground. He is going to keep beating that drum because, among other things, if the Europeans are going to keep sending the Russians money, the very least they can do for the Ukrainians is to provide some money there too. Remember, the Ukrainian economy is sort of bleeding at this point, enormous. I mean, by one calculation, $5 billion a month. That's hemorrhaging. And the Ukrainians are going to need a lot of help. So I think the subliminal message there is if you're going to keep sending the Russians these hundreds of billions of dollars for their gas, you should be sending more arms and more money to Ukraine to help us keep this fight going.
Bobby, obviously the war, as you were just alluding to, has had a massive economic consequence, but it also has taken a huge humanitarian toll, especially in the city of Mariupol. Defenders are still holding out, but they're encircled. They have not surrendered. If they are eventually forced to, how significant would that be?
Well, we've now been prepped for this for several days now. The message coming out of Mariupol and from Kyiv is that we're down to the last defenders. Mariupol will fall. I think the psychological impact of that has already been softened a little bit because we know this is coming. I think the focus will be on the incredible bravery of this small band of fighters that have held off the Russians for such a long, long time. There will be a political impact, of course. It's a big city, it's a port city. But you know what? The Russians have done so much damage to that city. It's not like they're going to walk in there and be able to use all of its infrastructure to then mount more attacks into Ukraine. So to some degree, the impact of Mariupol has already been contained, already been factored in psychologically for Ukrainians and for the wider world.
Yeah, to your point on destruction, of course, the foreign minister, Dmytro Kuleba, said over the weekend that the city just doesn't exist anymore, that it seems the Russian troops have decided to simply raze it to the ground. But while you're talking about the psychological impact, are we getting closer to the point where it looks like either side is going to be ready to give in, or at least give an inch to get to some kind of ceasefire agreements, or is there no more hope for talks at all?
Well, at this point, I can't see any hope. You mentioned in your previous segment of Roman Abramovich flying around trying to get something moving. He doesn't seem to have had any success. These rounds of talks that the Russian and Ukrainian officials have had in Turkey, no success there. The Russians have changed their strategy, but those changes are not a reflection of a change of heart. It's just recognition of the realities on the ground. So a month ago, a lot of Russian energy and focus and military strategy was built around trying to take Kyiv. They've clearly failed at doing that, and so they're now switched to this war of attrition. Long-distance artillery fire. Lviv was hit yesterday or overnight, which is, clearly the Russians now are thinking about laying waste to large cities and large portions of Ukraine, and hoping to wear down Ukrainian resistance, wear down international patience. But I don't see any interest in Moscow, and it really has to come from Moscow to stop the fighting.
Bobby, thanks very much. Although it's not exactly an optimistic note on which to end it, but we look forward to reading more of your work. Bobby Ghosh writes for Bloomberg Opinion. You can see his columns by typing OPIN-GO on the terminal. Coming up, Matt Maley, Miller Tabak Chief Market Strategist, talks to us about what to do in a rising rate environment. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Rent the Runway CEO Jennifer Hyman. That's at 5:30 p.m. in New York, 10:30 p.m. in London. This is Bloomberg.
We have never had a moment in the United States when inflation was above 4 and unemployment was below 4, when we didn't have a recession 2 years within the next 2 years. So we may pull it off, and certainly it's hugely important that we succeed in pulling it off. But the combination of overheating, followed by policy delay, followed by supply shocks, means I think it's a very difficult set of challenges, and recession in the next couple of years is clearly more likely than not.
That was former U.S. Treasury Secretary Larry Summers speaking earlier this month about a possibility of a recession. Now Goldman Sachs is putting their odds of a recession in the U.S. at 35% over the next 2 years. Joining us now is Matt Maley, Chief Market Strategist at Miller Tabak. Matt, good morning. Thank you so much for joining us early on this Monday morning. Where do you put the odds of a recession, and how does that affect your view on the equity market?
Well, I'm afraid I put it over 50%. When a major, I can't say it, but when an economist from a major Wall Street firm says they think it's 35%, usually means they think it's above 50%. They just, most economists won't tell you until we're actually already in the recession. But I'm kind of joking there. But the point is, what Larry Summers is saying is absolutely true. We have a situation where this situation with inflation being such a big deal, and it can be prolonged a lot more. I mean, your last segment, you talked about, this being a drawn-out war, where a war of attrition. That is the worst thing I wanted to hear, although it's an accurate statement. This means that these sanctions are going to be on a lot longer than we thought. Oil prices, food prices, et cetera, are going to stay high. That means the Fed has to keep has to be more hawkish for longer. A lot of people are hoping for them to be, to pull back a little bit early. Hope isn't a great strategy, and I really worry that this is going to cause some problems for the market. We can't be we can't fear this. Let's embrace it, take advantage of it.
Okay. So Matt, take advantage of it. How do you do that?
Well, a couple of things. Number one, the markets bounced back here and more, in the last couple of weeks, and that's really, I think, given people an opportunity to raise a little bit of cash to take advantage of what I think will be at least a retest of the March lows in the stock market. But more importantly, you want to look at hard assets, things that do well during inflationary times, and of course that includes energy stocks, agricultural stocks, et cetera. Those are the ones that are really going to, I think, do well in the next year.
So you think we'll get back down to 4,200, a little bit less, and then bounce back? Are investors still buying the dip? Do we still have that FOMO or YOLO or whatever it is, attitude in terms of drops? Because we recovered pretty well from the March lows.
We did, but there was really nothing new. I mean, and if anything that took place that was we got into the beginning of the year, all the things that were creating headwinds for the stock market have only gotten worse. Oil prices are higher, even though they're off their lows, they're higher. Inflation is higher. The supply chain issues are stronger and going to be prolonged. And of course, we have this war that didn't even exist at the beginning of the year. All of these things are worse. And the biggest thing is look at the divergence with the bond market. Everybody's focusing on that the Treasury yields have got moved back up. But look at credit spreads. High yield credit spreads are back to the widest levels, even slightly wider than they were at the March lows. This is all this divergence between the bond market and the stock market is big enough to tell me that people should be a lot more worried than they seem to be right now in the stock market.
What does this mean for your colleagues on Wall Street, Matt? I mean, you cut your teeth at Solly, went to Mother Merrill before joining Miller Tabak. Are those big banks that are still there, obviously, going to do as well this year as they did last year in terms of M&A, in terms of advising revenues, in terms of just net interest margins?
Well, that, again, when we talk about with the banks, of course, the net interest margins are so important. People focus a little too much on what, where the 10-year yield is. Yes, that's important, but it's much more important to look at the yield curve. And even though it didn't stay inverted very long, it's still very flat. And you just, they lend out at the high rate, pay out at the low rate. And if that spread is very narrow, their net interest margins aren't as good. Having said that, and, Bank of America reports today, for whatever reason, even when they report really good earnings, the banks seem to go down during earnings season, but that also provides a good buying opportunity. So even though I'm not as bullish on the banks as I was, say, this time last year or last summer, I still think there are going to be some opportunities there. You just have to be more nimble than we had been in the past.
All right, so buying opportunity in the banks, Matt. What about a buying opportunity in crypto with Bitcoin at the lowest level in about a month?
Yeah, I think that it's more of a risk on, risk off. So situation. Before people thought it might be a flight to safety or a hedge against inflation. That doesn't seem to be the case. So I do think there's going to be some more weakness here over the near term. But that $30,000 level seems to be an unbelievably strong support. If we break below that, we're going to have some serious problems. But I think we hold that level, and I do think that people, on a long-term basis, is still a great call. And so again, anything below 35,000 I think is going to be a great place to put your toe back into that market.
Matt, thanks so much for joining us. Happy Monday. Matt Maley there of Miller Tabak. You can catch, by the way, Kailey and I host a program focused on crypto every Tuesday at 1 p.m. Here in New York. You can catch that once a week, or you can watch it online. Tomorrow, we have a big deal. We're going to speak with the FTX CEO and billionaire Sam Bankman-Fried, as well as Hut 8 mining CEO Jamie Leverton, a program you don't want to miss. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York. Now, despite his online trolling tactics, Tesla CEO Elon Musk has a track record of being, well, not just a good business manager, but a great one, oftentimes maximizing shareholder value. That's the latest topic in a new Bloomberg opinion piece by our editor-in-chief emeritus, Matt Winkler. He joins us now on set here in New York. Matt, great to have you on this early Monday morning. So Elon Musk has given himself a really bad reputation, honestly, by tweeting so many weird things. The latest, as Kailey was mentioning, is an Elvis song, although it's probably double entendre. Nonetheless, you point out he's done a really great job of making money for those who invest with him.
Well, that's absolutely true. I mean, the big picture is nobody has gotten the world more excited about electric vehicles than Elon Musk. And then the result of that is that his company is worth almost 50% of all of the manufacturers of vehicles in the world. Think about that. And its performance in terms of revenue from sales, total return over 5 years, over 10 years, far exceeds anything in the top 10 largest companies in the world. And so it's a very consistent record now since the company went public in 2010. And no company comes close to Elon Musk in maximizing shareholder value.
It's amazing what he's done in terms of boosting revenue, in terms of hiring people, building a workforce, in terms of the market cap of his company. How does he do it? What is the thing that Elon Musk does right?
Well, it's that he's built a vehicle that is superior to anything that's on the market. And if you listen to people who have championed Tesla from its inception, say like Cathie Wood of ARC, she'll tell you that Elon Musk still, in things like battery technology, is 3 years ahead of everybody else, which is really quite extraordinary when you think about it, because everybody now is in the electric vehicle market. And so for Tesla to be the leader, also to be building factories in Berlin and Shanghai and Austin, Texas, and of course in California from the ground up is something that is totally different.
Well, it's not just that, right? I mean, we're still using, I used PayPal this weekend. He just sent 4 private citizens to the ISS. That's like mind-blowing. It's not just Tesla. It seems everything he touches, maybe with the exception of the boring company so far, turns to gold.
Well, I think that's right. But I think, what you have to look at is Tesla in particular, because that's really the big story. And unfortunately, the antics, the histrionics that you're citing obscure the fact that Tesla has just been an astonishing performer. No company got to $1 trillion valuation as fast and stayed there as Tesla, ever. I mean, it's not even close.
But of course, that doesn't necessarily reflect entirely the fundamentals for Tesla, right? There's a certain amount of, not memification of Tesla stock, but the star power of Elon Musk brings with it a certain performance in equities that you don't necessarily see with public companies usually.
Well, I think that's right. But having said that, there's no substitute for the vehicle itself. I mean, people have to like it. People have to feel good about it. People have to appreciate it. And that's a track record that can't be denied in the context of everything else that he's doing.
Well, and to your point about batteries, about factories, the narrative now is that Tesla isn't just a regular car company. It's about something a lot bigger. Matt was talking about kind of the antics on Twitter. Can we talk about the other Twitter situation? I mean, even if Elon Musk doesn't outright buy Twitter, if he's not able to do so because of the poison pill or whatever, are there lessons that Twitter could learn from him?
I'm sure everybody can learn something from Elon Musk. I mean, whatever his eccentricities are, he's a brilliant CEO. And so he probably has a lot to offer. And that's why people have to pay attention to him.
What's your take on his Twitter bit? I mean, he says, we saw him in a TED Talk recently, he's doing this for the good of society, for democracy, for free speech, and he's not worried about the economic consequences.
I don't think Elon Musk is that glib, actually. I think there's a lot of integrity in what he says, even if it comes across as crass or, as I said before, eccentric. He believes a lot of things. And, for example, climate change has been something that has been a dear subject of his, going back 15 years. And when the rest of the automobile industry had very little, if you like, interest in dealing with climate change directly, Elon Musk was at the forefront. And of course he is today. And that's when everybody is taking it seriously. And
now they're chasing after him, trying to copy what he's done. Matt, thanks so much for joining us. Matt Winkler, Editor-in-Chief Emeritus and creator of Bloomberg News. Great to have you on set this morning. That's it for Early Edition. Surveillance is ahead, the OG Surveillance. We'll hear from Michelle Meyer of MasterCard and Dan Skelly of Morgan Stanley Wealth Management, among others. Tom Keene is in the house with Lisa Abramos. Is Pharaoh here? Is Pharaoh here?
He's back.
Pharaoh's back. Pharaoh's back. So a full house on Bloomberg Surveillance next. This is Bloomberg.